So I almost choked on my coffee this morning when I came across a story out of CNBC from today. And it's entitled Affirm Gets Boost from New York Life with $750 million loan deal. As I started digging into this story, it got me thinking, when was the last time that a big life insurance company, a U.S. life insurance company, got involved in backing a financial asset and basically almost went broke, but for a bailout from the U.S. taxpayer? Remember AIG in 2008 with the subprime mortgage? I'm going to jump into this story. I want to get your thoughts and comments. We're heading down the same exact path, and the fall will be epic. Doing the show early today because I'm about to jump into a deposition, and it's going to go about 8 hours. So I won't have time to record and put up a show later. But I thought this would be something interesting to ponder going into the weekend as the stock market continues to rally. The NASDAQ, the Mag 7 is driving the gains, the earnings, okay? But the more we see concentration and gains in just a handful of stocks and more people are FOMOing in, okay, on those stocks, the bigger this is setting up for a fall. I'm going to talk about another fall right now. That's going to be what New York Life is doing. And with Affirm. Now, you know what Affirm is? Affirm is the buy now, pay later company. Okay, so their assets are the receivables they have from basically broke consumers that can't afford to buy their stuff for cash. So they spread it out over 3, 4, 5, or 6 pay. Probably the same consumers that, have maxed out their credit cards. So they're having to rely on Bnpl. Okay, that's just my editorialization. I'll jump in the article. They're saying that the credit performance is strong behind the buy now, pay later. If that's true, I haven't dug into it. If that's true, maybe it's strong until it isn't, okay? Subprime mortgage was strong until it wasn't, and then you know what happened. Before I jump into the story, as I always humbly ask, if you're not subscribed to the channel, please hit that subscribe button for me so we can keep growing to the community, and welcome to all the new subscribers over the last couple of weeks. I appreciate you. So out of CNBC today, Affirm is expanding its partnership with New York Life Insurance, a move that highlights how traditional finance giants are deepening their exposure to fintech-driven consumer lending. Right? We get these fancy terms now, fintech-driven consumer lending. Okay, it is basically consumers and companies, I don't say preying, but or offering a service, whatever you want to call it, flip side of the same coin, to people that can't afford to buy stuff outright. People get some negative comments saying, "Oh, come on, Matt, it's a convenience tool, this and that," whatever. Everyone's got their own perspective, but if they can afford to buy it outright, then most would. Under the new agreement, New York Life will purchase. Here's the key: will purchase up to $750 million worth of Affirm's installment loans through 2026, giving the payments company fresh off-balance sheet funding to support roughly $1.7 billion in annual loan volume. That's a mouthful. That's a pretty packed statement. But what number one is New York Life is purchasing. So that means that Affirm is basically assigning or collateralizing its loan from New York Life with its performance on its loan portfolios to buy now, pay later consumers through 2026. And they're providing liquidity to Affirm, but they're calling it off-balance sheet funding. So Affirm, again, I'm not a CPA, I'm not a forensic accountant, so if you guys understand this, weigh in on it. But off-balance sheet doesn't even have to be part of the regular accounting methods, okay? And that's to support roughly $1.75 billion in annual loan volumes. So they're going to take the $750 million, okay, from New York Life, maybe in the form of lines of credit or something, and they're going to multiply that out. They're going to lend that out to to buy now, pay later clients or consumers, which will generate 1.75 billion in annual loan volume. Okay, so the monster keeps growing. So is this, tying this back to the concept from the shows the last couple of weeks, is this idea of non-depository financial institution transactions, NDFIs. Is this an NDFI? Well, Affirm is acting as the intermediary, New York Life is acting as the bank, and the buy now, pay later consumers, all right, that are using the services and taking out this debt, are the ones that are, let's say, as long as they're making their payments, they're performing. But technically, because New York Life is not a bank and Affirm is not a non-depository financial institution under the rules, none of these institutions even have to, none of these parties, either New York Life or Affirm, by my reading of this, even have to do traditional oversight or reporting of this transaction, okay, in terms of call reports, things like that. It doesn't apply because they're not banks. But I don't care. You can call whatever you want. This is NDFI, okay? And the collateral is the performing loan portfolios on the buy now, pay later deals. What happens when these people, the buy now, pay later consumers, lose their job, right? What happens when they their income, or they lose their job, or just their income's not keeping up with rising inflation and the costs, and they have to decide what things they're going to pay? Are they going to Are they going to spend the few dollars they have to buy food for their family, or are they going to pay their third payment of $5 on their buy now, pay later? Okay, love to get your thoughts and comments on that. We all know what's going to happen. This whole line of BS of the consumer is strong is simply not true. Okay, the consumers are spending using credit cards, using debt, using buy now, pay later. Okay, and we have life insurance companies now making massive bets, right? So again, what happened with AIG in 2008? AIG was making massive bets on subprime, and they were basically, it's complicated, but they were issuing basically like they sold what's called credit default swaps. They were issuing insurance contracts on the mortgage-backed securities, okay? And they were collateralized debt obligations, okay? What happens is when the subprime mortgages, when the borrowers started to fail and miss payments and those things, and there was no real collateral, they were stated income loans, all that nonsense, and those started to blow up, right? There were massive liquidity calls, and AIG couldn't do it, okay? So they would have gone belly up, okay, one of the largest life insurance companies in the United States, but for a federal government taxpayer bailout, okay? So if you like it, if you will, that the mortgage-backed subprime mortgage to the buy now, pay later thing right now, and everyone's saying, oh, it's the latest and greatest. Well, until it isn't, until the buy now, pay later consumers start missing their payments and walking away from their obligations. Up until recently, this stuff wasn't even, the buy now, pay later wasn't even put on credit reports. And the credit reporting agencies are still trying to find workarounds, right? So that it's not traditionally affecting credit, right? So it invites, I would say, even more abuse by the consumers, okay? So again, that's why, I'm going to keep going here. New York Life has, to date, the insurer has funneled nearly $2 billion into Affirm's collateral pools. The partnership, it says, is part of a broader trend of insurers and private credit investors moving deeper into consumer finance as higher interest rates make these assets more attractive. And then they talk about how Affirm has also secured similar funding with Liberty Mutual Investments, PGIM, and Sixth Street Partners. So this is another level of what I would argue is contagion in the system. It all relies on the consumers making those payments. We know what's happening in auto, subprime especially. We know what's happening with foreclosure. We know what's happening with bankruptcies. This is, from my perspective, folks, the next, whatever you pick, there's a number of them, shoe to drop. And this is going to be an epic collapse. And ultimately, if it gets up to New York Life, to some of the other, mutual, whatever it is, mutual insurance company, it's going to be a total disaster. So there was another same story was shared on the Tech Buzz I saw, and they kind of covered a couple other, let's say, angles of which I'll address briefly, and I'll wrap it up for the day because I got to get going. But they're saying that the insurance giant New York Life has funneled nearly $2 billion into Affirm's collateral pools through various asset-backed securities. So again, I question, rhetorical, what are these asset-backed securities? They always use these terms so people just glass over it and think, oh, it sounds good, right? Well, from what I can tell, the asset-backed security is, the hope and prayer that the consumers of the buy now, pay later loans are going to make their payments. Those buy now, pay later consumers, they don't pledge collateral when they go and get a loan. They just agree to make 5 payments at, whatever their monthly amount is. Okay, so it's the buy now, pay later receivables being, let's say, assigned or offered up as collateral to the largest, one of the largest life insurance companies in the United States for billions of dollars of lines of credit so they can go and lend more money to more consumers that probably shouldn't be borrowing it. So I guess the takeaway is what could possibly go wrong. All right. And if New York Life's doing it, other insurance companies are right back in the game as well. All right. So again, subprime was fine until it wasn't. And once the losses started cascading and they started blowing up, it became a self-fulfilling prophecy, and the whole system collapsed. And as you know, if you lived through 2008, it started out as subprime. Remember, Bernanke, it's contained to subprime. It took down the whole system. So they're saying in conclusion that buy now, pay later as a legitimate asset class is viewed by institutional investors as a legitimate asset class worth billions in commitments. Legitimate asset class, which is based solely on the faith that the consumers will remain resilient. So somehow the banks, the life insurance companies, the buy now, pay later companies have all convinced themselves that the consumers are strong, that AI is not going to continue to take over massive jobs in this country, that somehow the income is going to keep up with inflation, and everything is just going to be rosy. I know I'm being a little facetious, but again, this stuff, guys, is, if you lived through 2008 and you saw how much misery people went through because of this kind of stuff, it's really, from my perspective, no different. If you disagree with me, if you have a different take on it, let me know. Is it traditional NDFI? Technically, under the definition, it's not, but it's the same setup. Okay, it's the same setup. Again, I share with you with the Zions Bank disaster last week that in that case, the intermediary pledged, right? They assigned the proceeds from first deeds of trust, which didn't even exist. Same idea. The larger bank, in this case, Zions, was relying on payments, income coming in from payments on that first deed of trust. Same thing. In this case, New York Life ultimately, for repayment of their $2 billion, is relying on the upstream of the buy now, pay later consumers timely performing their obligations. All right, stay tuned. Okay, I'll stop there today. It's a little bit longer than I wanted to. This is very, very serious and very, very unfortunate, from my perspective. So if you enjoy the content, leave me a like. If you're not subscribed, please hit the subscribe button for me. Leave your thoughts and comments. And with that being said, I will talk to all of you soon. Bye.